Welcome to the deep dive. Today, we're really getting into Aon PLC's latest Q2 2025 earnings. They're a major player, obviously, in risk, health, wealth solutions.
Yeah, absolutely.
We've sifted through the earnings call, the financial reports, analyst notes, all of it. Our mission really is to boil it down and figure out what actually matters for you.
And it's fascinating, isn't it? Taking all this dense financial data and, well, trying to turn it into something actionable, to see the story behind the numbers and, what it might signal for the wider market.
Mm.
Aon's Q2 definitely gives us a lot to chew on.
It really does. So let's start right at the top. The headline numbers. Some pretty impressive figures just jump out immediately. Aon's total revenue up 11% to $4.2 billion. That's a pretty substantial jump.
It is a very solid top line. And the metrics underneath, well, they paint a picture of really robust performance too. Organic revenue growth came in at 6% for the quarter.
Yeah.
And what's interesting there is how consistent it was. Commercial risk, reinsurance, health solutions, all at 6%. Wealth was strong too, at 3%.
Okay, so broad-based growth.
Exactly. And then you've got adjusted EPS growth, up a very healthy 19% compared to last year. But maybe the most eye-catching number, free cash flow growth, up an incredible 59%, totaling $732 million just for the quarter.
59%. Wow.
Yeah. And their adjusted operating margin improved too by 80 basis points, hitting 28.2%. That's almost a full percentage point gain. Shows
Yeah.
some real efficiency improvements.
Okay, but that free cash flow number especially, 59%, we need to unpack that. What's actually driving that kind of, well, explosive growth?
Right. A big factor, and it seems to be kind of Aon's secret weapon lately, is what they call their Aon United strategy.
Yeah.
It sounds like internal jargon, maybe, but it seems to be a really cohesive approach. It demonstrates how internal alignment can be just as powerful for growth as, say, external market trends.
Aon United, so getting everyone pulling in the same direction internally?
Pretty much. It's not just about saving costs through efficiency, though that's part of it. It's really about unlocking new revenue by connecting services that might have been, siloed before.
So does that mean for a client they get like one point person for everything? Or is it more behind the scenes collaboration?
It's a bit of both, I think.
Yeah.
The goal is a more holistic client experience. Aon can provide its full range of capabilities to solve a client's problem. Rather than the client having to navigate different departments, they bring the experts to the client. And this proactive approach, it's letting them not just capture existing demand, but actually create new demand, especially in hot areas like cyber insurance and reinsurance.
That makes a lot of sense. And speaking of drivers, another huge one has to be the NFP integration. That acquisition seems to be really exceeding expectations, which isn't always the case with big deals.
No, it isn't. And this really does highlight some effective post-acquisition management. NFP is directly boosting overall revenue and operating performance. They're apparently on track for that $80 million net revenue synergy target for 2025.
Okay.
And they're also expected to kick in about $300 million in free cash flow just in 2025.
Wow.
With projected revenue synergies hitting $175 million by 2026.
So how are they actually getting those synergies? What's the mechanism?
Well, it's quite clever, actually. They're transitioning NFP clients away from using third-party wholesale brokers for certain things and bringing that business onto Aon's own platform, using Aon's expertise. Plus, they're leveraging their big Aon Global Broking Center for placements. So it brings more business, more revenue, and crucially, more control in-house.
Right, keeps it all within the Aon ecosystem. Smart.
Yeah, exactly. And while, no integration is ever perfectly smooth, the way they consistently talk about NFP's performance suggests they've handled any bumps pretty effectively. They seem focused on realizing those synergies.
Yeah, sounds like good planning, good execution. And it's not just deals and strategy, right? It's people, too. They mention investing in client-facing talent. Headcount up 6%.
That's right. Revenue-generating headcount up 6% through June 30th. And that investment is, well, it's absolutely crucial. It directly improves their ability to deliver for clients, better outcomes, stronger relationships.
Makes sense.
When you have more skilled people talking directly to clients, it strengthens the relationship, improves service, and that ultimately fuels future revenue. Client retention, new business wins. It's foundational.
Okay, so lots of positive momentum, strong growth drivers. But no company operates in a vacuum. There are always headwinds. Let's talk about the forces pushing back a bit against Aon, even with these impressive results.
Yeah, if we connect this to let's say, the bigger picture, while Aon's growth is clearly strong, the overall macroeconomic environment is still, well, uncertain. No getting around that. And that creates challenges. For Aon, yes, but also importantly for their clients, it affects risk appetite, investment plans. It's like running uphill constantly.
Right. And looking specifically at their financials, there are a couple of things that stand out as maybe areas of concern. Interest expense, for example, still pretty high at $212 million, even though it's down a bit, $13 million lower year over year.
Right. That's a significant number to service debt.
Uh-huh.
And on the flip side, interest income was negligible this quarter. And another thing, fiduciary investment income, that's the earnings they make on client funds they hold temporarily, that actually decreased by 12% compared to last year. It's maybe a smaller piece, but it does impact the overall revenue picture.
And what about specific segments? Any pressures there?
Yeah, they mentioned some pressure in the reinsurance segment specifically, coming from rate declines and also higher retentions.
Meaning clients are keeping more risk themselves.
Exactly. Holding on to more risk instead of transferring it all to reinsurers. That can squeeze margins a bit in that specific area.
Got it. And then there's the leverage objective. You mentioned their current leverage ratio is 3.4 times. What should we read into that?
Well, it basically tells us they're still working towards their target. Management has made it clear deleveraging is a priority. So while the ratio might be down from where it was, they still see room and have the strategic intention to strengthen the balance sheet further.
Okay. And worth noting, Guru Focus flagged 4 warning signs for AON. We won't dive deep into those now, but it's something analysts are certainly aware of when looking at the financials.
Always good to keep those external checks in mind.
Definitely. But let's move on to the Q&A from the earnings call. This is often where you get, the real strategic nuggets, the things analysts are pushing on. One question was about where growth was coming from, specifically capital markets activities versus new hires. Were they expecting more impact later in the year?
Yeah, that was an interesting exchange. CEO Gregory Case, he emphasized that M&A advisory services are a significant focus, said pipelines they were picking up. But he also stressed that overall growth was really broad-based.
Not just one thing.
Right. And the CFO, Edmund Reese, added to that. He said M&A activity strengthened in Q1 and Q2. They expect modest growth in the second half, but again, driven by those broad factors in new business generally, and those priority hires starting to contribute more. It suggests, a diversified growth engine, not overly reliant on any single area, which is good for resilience.
Makes sense, especially in an uncertain market. Diversification helps. Another big topic was capital allocation. Analysts were asking about priorities for that strong free cash flow and appetite for more big M&A deals. Where's the cash going?
CFO Reese was pretty direct on this. He said Aon's in a position of strength with flexibility because of that cash flow. But the number one priority, deleveraging, addressing that leverage ratio we talked about.
Okay, so discipline first.
Discipline first. Strengthening the core financial position. But, he added, they will evaluate potential acquisitions if they meet strict strategic and financial criteria. They're focused on return on invested capital, cash-on-cash return. So any M&A has to really prove its worth. It's not growth for growth's sake.
And related to M&A, was their current M&A advisory business heavily weighted somewhere, like geographically or by industry? And how are the margins looking there?
Gregory Case said it's broad-based, across different regions, different industries. He made a point of saying they've expanded beyond just the classic private equity focus. They're doing more with the corporate world, too. And Edmund Reese confirmed, M&A growth is broad. Margins are in line with expectations. And the overall goal is margin expansion across all their solutions, not just one area.
Got it. Okay, finally, let's just circle back one more time to that free cash flow number, that 59% jump. How exactly did they pull that off? What was the mechanism?
Right, the how. CFO Reese broke it down. He said it was primarily driven by, first, operating income growth, which includes, crucially, those contributions from NFP. Second, improvements in working capital, basically managing their short-term cash flows more efficiently. And third, lower transaction and integration costs compared to previous periods when they were digesting other deals. And he specifically reiterated their confidence that NFP will contribute that $300 million to free cash flow in 2025. So it's a mix of strong operations and cleaning up post-acquisition costs.
So putting it all together, what's the big takeaway here? It feels like Aon is performing this impressive balancing act, firing on all cylinders with growth strategic initiatives, NFP paying off while simultaneously navigating these persistent headwinds, macro uncertainty, financial pressures like interest expense. It's quite something.
It really is. It showcases resilience, I think, and agile strategy in what's still a pretty volatile global market.
Yeah.
And to synthesize it, their strategic clarity really stands out. That Aon United strategy isn't just talk. The NFP integration looks very successful so far. And they have a clear capital plan. Deleverage first, but keep an eye out for truly strategic M&A. It's a coherent blueprint.
Yeah.
So what does this all mean for you listening? It's about seeing how a company can manage really effectively both significant tailwinds and those persistent headwinds at the same time.
Definitely. We've seen their multi-pronged growth approach capturing existing demand, creating new categories like cyber, plus the big strategic M&A like NFP, which leads to, I guess, a final thought for you to consider. How do these diverse growth engines combined with that real focus on deleveraging offer a kind of blueprint, a model for companies trying to balance aggressive expansion with financial discipline, especially now in such an uncertain world? What parts of Ann's strategy might actually apply to other industries you follow? Something to think about.